You are listening to The Vocal Technologist. Spoken Tech for your ears.
You look at the financial tech world week to week, and honestly, it can give you whiplash. It just feels like you've got these two totally different stories playing out side by side. On one hand, you see these incredible, record-breaking valuations. And on the other, some pretty ruthless, really focused cuts and strategy shifts. How does that even square? So today, let's try and make sense of it. We're going to take a look at these recent fintech moves, the ones really shaping the competitive landscape right now. We'll cover the big visions, the $100 billion infrastructure plays, but also the real nitty-gritty stuff, the fights over data, payment rails, all that plumbing. Our goal here is to quickly get a handle on where the smart money seems to be heading and, well, what that pivot really means for everyone involved.
That duality you mentioned, that's spot on. I think the days of just spraying money broadly across startups, that's basically over. What we're seeing now is capital getting laser focused, really on two main things, these super concentrated bets on AI and then controlling the essential, often expensive financial infrastructure.
Okay, let's start with the big positive headline then, the one showing that underlying strength. Stripe. They basically define digital payments plumbing. Right. And their valuation just jumped to a record $106.7 billion.
Yeah, a new record.
That's officially higher than their 2021 peak of $95 billion.
Yeah.
And get this, they did it while staying private. That number alone, it just screams that the need for simple, reliable payment infrastructure isn't going away. It's fundamental.
It absolutely is. And
Yeah.
actually, Stripe's strength, that foundation, is kind of what enables some of the riskier plays we're seeing elsewhere. Which brings us to SoftBank. This is where it gets really interesting. SoftBank, the venture capital giant, they're laying off almost 20% of their Vision Fund staff. That's over 60 people from a team of just over 300.
Wow, 20%. That sounds like a massive crisis brewing, doesn't it? Especially with all the market choppiness we've seen lately.
You think so, right? On the surface, yeah. But here's the strategic calculus behind it. It's pretty ruthless, these cuts. They're happening after the Vision Fund just had its best quarter since 2021.
After. Okay, that changes things.
Exactly.
Yeah.
So this isn't weakness reacting to bad times. It's a cold, calculative strategic shift. Masayoshi Son is going back to his roots, high risk, high reward. He's ditching the broad portfolio approach for these super concentrated, high stakes bets purely on generative AI. And think about the scale here. They've already put, $9.7 billion into OpenAI.
It's just incredible sums.
And they're backing Sun's huge, almost unbelievable $500 billion Stargate project. That's about building massive U.S. data centers purely for AI. Plus, they're shoring up their ecosystem around ARM, NVIDIA, looking at chip acquisitions. It all fits together. Stripe's huge valuation proves the basic plumbing is valuable and needed. That frees up capital for these giant swings on what they see as the next big thing, AI.
The message couldn't be clearer then. If your business isn't fundamentally tied to AI, either enabling it or using it deeply, SoftBank is probably looking past you for those moonshot returns. Okay, so we have the massive AI vision way up high, but down in the trenches, the day-to-day fight is really about that transactional infrastructure, isn't it?
Definitely.
Let's talk about open banking and the friction over data access. Plaid, the big connector, and JP Morgan Chase, the banking behemoth, they struck a deal. But the catch is, it introduces fees for Plaid getting access to consumer financial data.
Right, and that's the critical bit. This potentially creates a really problematic two-tier system. Now, both sides, Plaid and Chase, they say the fees are about ensuring safe, stable, open banking. Fair enough, maybe. But the fintech trade groups, they are absolutely furious. They're calling the fees anti-competitive, maybe even unlawful.
Why unlawful? Doesn't the bank sort of own the data, or at least the access? Why can't they charge for it?
Well, they can charge, but it's about the impact on the market. That's the argument. If these fees become too high, sure, the big banks can still afford access. But what about the smaller fintechs, the innovators relying on Plaid or similar services?
I get priced out.
Exactly. It could effectively choke off competition and limit consumer choice. And the timing is crucial right before the Consumer Financial Protection Bureau, the CFPB, is expected to finalize its big open banking rule update. So yeah, the lines are being drawn very sharply over who owns your financial data, who controls access, and who profits from it. It's a major battleground. And while that data war is heating up over traditional bank accounts, if you look over at the crypto side, the digital borders, the infrastructure competition is just as intense there, particularly around stablecoins. What's really fascinating is the pressure building on Circle's USDC. JP Morgan analysts actually warned about intense competition coming.
I always thought USDC was pretty much the gold standard,
Yeah.
the compliant, audited US dollar stablecoin. Who's really got the power to challenge them now?
Well, it's becoming a bit of an arms race. You've got new players and established giants jumping in. Tether, for instance, is prepping its own compliant stablecoin, USA. There's Hyperliquid launching USDH. And maybe more importantly, big fintechs like Robinhood and Revolut are exploring launching their own stablecoins.
Okay, so everyone wants a piece.
Everyone. But the warning from JP Morgan wasn't just about more coins existing, it was about utility. The fear is this becomes a zero-sum game. These competitors aren't necessarily bringing new money into crypto. They might just be fighting over the wallets of existing active crypto traders.
Shuffling the same pot of money around.
Pretty much. It's more like an internal transfer unless the whole crypto market itself expands significantly, bringing in mainstream users. It's a fight for existing market share.
That fight for share. It brings us back to the consumer focus, doesn't it? Is chasing the next generation of users a better bet than just building B2B plumbing? Look at Block's Cash App. They use their debit card to launch a post-purchase buy now, pay later feature.
Right, piggybacking Afterpay's tech.
And apparently, it took off. They got 1 million users just since February. And it hit a lending run rate of $2 billion a year.
That's a really key move. Block is trying to position Cash App as the sort of next-gen credit card. It appeals directly to younger folks who might be wary of traditional credit. They're using lending, basically Afterpay's capability, to make their whole consumer ecosystem stickier. It's very much a growth play driven by lending.
I see that focus. Now, contrast that direct consumer lending approach with the B2B side. Growth there seems more focused on, like, SaaS models. Big extent, they work in corporate spending. They just raised $20 million to launch their paid SaaS product.
Different model.
Yeah, their whole game is scaling partnerships with banks. They're integrated with over a dozen already to get deeper into that huge $1.6 trillion U.S. corporate card market. It feels like a steadier, maybe lower risk, fee-based approach.
And if we zoom out again, connect this to the bigger picture, these fights within the U.S. or specific regions, they're being watched everywhere. And some companies, their ambition is purely global. Revolut is a prime example. They just unveiled this massive $13 billion investment plan.
$13 billion. For what?
Their goal is huge. 100 million customers across 100 countries, all by 2030. They want to be the first truly global digital bank. It really highlights that ultimate end game for some, massive geographic reach and scale, rather than just dominating one domestic market.
So while these infrastructure wars are playing out and valuations are hitting the stratosphere, AI is also quietly, or maybe not so quietly, changing how finance works from the inside. We're starting to see this concept of autonomous finance emerge. Like Appzen, they just raised $180 million to push their agentic AI platform.
Agentic, that's the key word there, isn't it?
Yeah, explain that a bit. What does agentic really mean here?
Think of it like this. It's not just AI as a calculator crunching numbers faster. Agentic AI is more like, well, like a digital coworker. It can understand a high-level goal, say, process these invoices, then figure out the steps, interact with different systems, execute the whole process, and report back, all from one prompt.
Okay, so Appzen wants to turn routine stuff, like expense management or accounts payable, into these digital team members for the CFO's office, promising to cut costs, reduce errors, maybe even fraud. It really changes the nature of back office work. I guess this is the vocal technologist in me speaking now, but that feels like more than just automation. It's transforming the management of financial processes.
Absolutely, and it's not just general tasks. It's tackling really specific, painful compliance headaches, too. Look at Numeral. They secured $35 million specifically to deal with the nightmare of U.S. sales tax compliance across all the different states.
Oh, that's a big one.
Huge. Using AI to automate figuring out the right tax, filing it, sending the payment. That's a massive relief for finance teams drowning in that complexity.
And this isn't just startup streaming. It's hitting the big players already. Citigroup, for example, is piloting agentic AI capabilities.
Wow, Citi.
Yeah, with 5,000 staff inside their own platform, Stylus Workspaces. They want employees to be able to kick off complex, multi-step tasks across different internal systems with just one simple prompt, streamlining operations massively. Now, here's a quick aha moment for you listening, especially thinking about all this rapid innovation and the pressure to move fast. It's kind of an open secret in fintech, isn't it? A lot of these successful disruptors, they didn't actually build everything from scratch.
Not at all. They often launch using existing platforms, borrowed rails, if you will, because speed to market is just everything, right?
Exactly right. We know huge names like Chime, Current, even SoFi initially built on Galileo's platform,
BaaS banking as a service.
and others like AngelList, Honeybook, Wix used Unit's platform to embed financial features quickly. So the core choice for founders becomes, do you want the incredible speed and lower upfront cost of using these platforms? Or do you need absolute control, even if it's slower and more expensive?
And right now, in this environment, time to market seems to be winning out, which really validates that whole platform-based model.
Okay, so let's pull this all together. To summarize what we've unpacked today, it feels like the market's coalescing around maybe three big themes. First, that intense, almost ruthless focus on pure AI, like we see with SoftBank's huge pivot.
Yep, the big AI gamble.
Second, these really high-stakes fights defining the new infrastructure landscape, whether it's wrestling over data access fees or battling for stablecoin dominance.
The plumbing wars.
And third, that ongoing, probably inevitable push to automate the heck out of the finance department using this sophisticated agentic AI.
Yeah, it's a landscape shaped by intense focus and this relentless drive for scale, really.
But, with all these massive valuation bets flying around, Stripe hitting $106 billion, Revolut planning $13 billion of investment, Cash App building a $2 billion lending book, it brings us back to the most fundamental question, maybe the most important one. How do these fintech giants actually plan to make money consistently over the long haul?
Right, the underlying business model.
Think about the contrast between, say, Nubank and Revolut. Nubank's engine is primarily lending, right? Making money off interest from its huge customer base, mostly in Latin America.
Classic lending model, just scaled massively.
Revolut, on the other hand, seems to rely more on fees, interchange fees from card use, foreign exchange markups, subscription tiers, a different engine altogether.
Very different.
So the question for you to think about is, which of those models, the lending-driven one or the fee-driven one, do you think has a longer, more sustainable runway in today's, let's face it, pretty volatile landscape?
That's the key question. Lending can bring high returns quickly, but comes with significant credit risk, especially when you scale fast or enter tricky markets. Fee-based models are often more stable, less risky day-to-day, but they depend entirely on attracting and keeping loads of active users, often globally. Understanding which engine powers their growth, that tells you a lot about who might be built to last.
Something to chew on. Until next time.
Spoken Tech, for your ears.